Now we will move on to the next session. Our next speaker, Mr. Chinmay. He's a chartered accountant. He's a graduate company secretary, SEMA at strategic level. He has done certified forensic audit and fraud prevention professional. He's a registered valuer as well. He was associated with PwC and presently he is with Guru Jana. Over to you, Mr. Chinmay. Thank you.
Hello, Shilpa. Thank you for the kind introduction, and thank you everybody who are all here. I think we would have I just could log in at 9:20 and was following the conversation, and it seemed very interesting session we just have. Also glad to see so much interaction happening. So now, I was thinking just now that we've been doing a lot more meetings and conferences. Much higher than before COVID, what we used to do is, only it was our inhibitions that, okay, webinar, whether it will be full effective or not, only those thinking. And we used to think that if you make physical sessions, then a lot of socializing and all will be there. I think few people are unmuted. Shilpa, is there any way we can mute everybody?
Yeah, I'll mute everyone.
Okay. So now those inhibitions, because of the compulsion of lockdown and other things, have been gone away. So, and it is good that we are doing a lot more meetings and sessions through this. So now I'll just share my screen first. So yeah, so as I was saying, the next session, Shilpa was asking, what do we talk about? We have beta and other things in the first session, and little more a detailed topic or a comprehensive topic, generic topic we can have for the second session. So we were talking, then we thought a lot of queries I keep receiving in on cap table. That means different kind of instruments. How do we value ESOP? What do we do? And nowadays, the law firms have been successful in convincing the corporates to use as complex instruments and SHS as possible. So that will also lead to a lot of confusion and deeper thinking in valuation also with respect to those instruments. So in this session, mostly we'll be discussing between enterprise value to instrument value. I mean, in that, like, nothing until the enterprise value, which is the common discussion in most sessions we'll have. But now we'll see after enterprise value to the instrument, how do we move? Is there any difference? If so, what is the difference? How to handle and those things. So to start with, we'll start with different possibilities of capital structure. So in this, I'll try to not only from valuation. In this, I'll try to go a little deeper on the instrument itself and on the Companies Act, income tax and provisions, something like that, because some of us may be aware about this, some of us may not be aware about it. So we'll try to see a little bit basic of the instrument also, so that because each basic point is very much vital to see how and what adjustments to be done from valuation perspective. So once we know the instruments very well, then it will be a little more better in analyzing the valuation treatment for that. So we've categorized the instruments as four categories. First is pure equity instruments, which means okay, when we see the other types, we'll get to know what is pure equity instruments. In this two, one is plain equity and the other one is shares with differential voting rights. So plain equity is nothing but whatever we would have seen, say any small private company, what we would have seen, just one class of equity shares, some 10,000 shares, two shareholders holding, that is plain equity share. If any shares are there which has differential rights, which is possible under Companies Act, it was possible under 1956 Act also, and same thing is available in New Companies Act. So that instruments, which say for example, if we have an instrument where Class A equity shares has 1:1 voting rights, which is plain equity shares, and Class B equity shares, which has one voting right for 10 shares, then that is a share with differential voting rights. So obviously valuation should differ. We'll come to that how it will differ, but this is the difference between two kind of shares. And as I was saying, Companies Act, there is a recognition. Income tax, there is no recognition specifically for this class of shares. So any share which having a differential voting rights also will be waived on par with normal equity shares. And in case of FEMA also, there are no distinguishing requirements, or in the law that doesn't distinguish between these two. However, compared to income tax requirement and FEMA requirement from valuation perspective for these two categories, is that FEMA says internationally accepted pricing methodology. Hence, all of these differences very much matter when we give valuation report for FEMA. But for income tax, since it gives a specific methodology, for example, 11UA says somewhat relating to NAV approach. So even though it's a differential voting rights or any kind of it, as long as they are equity shares, we need to give the same valuation reports. Maybe a disclosure could be possible, saying that this obviously disclosure that it is as per 11UA valuation is what we have done would be anyway there. And additionally, maybe another line of disclosure saying this is differential voting rights, because we have not, though technically an adjustment is required, we would not have done it. So maybe another line of disclosure would help. Apart from that, there is nothing different. Nothing needs to be done from income tax. Of course, FEMA, we need to address it rightly because it's an internationally accepted method. And in case of Companies Act or SEBI or any other requirements also, we need to duly address the two different categories in a different way, which we'll see how to address a little later. So second class is pure debt instruments. Redeemable preferences is first one. I'm calling it as debt instrument consciously, though it is not debt. The preference shares is a very, very interesting category. It's just because Companies Act calls it as preference shares, we need to call it as preference shares. Otherwise, it doesn't have the essential characteristics are not that of a equity or a risk, because it has a fixed rate of dividend, but slightly of equity nature, because the way in which you pay the return is by way of dividend, and also dividends will be paid only when profits are there. If profits are not there, then dividends are not payable. It can only carry forward to next year, but there is no compulsion that dividend has to be paid if there is no profits, like interest. And to that extent, it is share. But however, it will have fixed rate of return. Of course, participation can be possible, but fixed rate of dividend would be there, and to that extent, it will be debt. So those commonly seen redeemable preference shares will be that of fixed rate of dividend without any participation rights, generally. So if those shares are there, it is better to look at it as debt instrument, will better comprehend the valuation. But if it have participation rights and a few other features akin to equity, then it may be wise to classify it as equity category. So then other debt instruments would be debentures. All private companies and also probably public companies also could issue debentures. We commonly see debentures. Debentures, what we mean here in this category is redeemable debentures and not compulsorily convertible debentures, which is very common, which is we'll see in the next category. Then bonds and notes. Bonds and notes generally we don't see in case of private companies, but large corporations issue bonds and government bonds also will be there. Then next category is equity, dilutive equity instruments. So these are all not equity instrument, but in effect almost similar to equity instruments when we do from valuation perspective when we think of it. One is convertible preference shares, convertible debentures, and convertible bonds. All are mostly similar except for the basic characteristics of the instrument. Then is the options. One is equity settled options. That means any option which leads to an equity share being allotted, which is ESOP is one and share warrant. And then other category is cash settled options, where we don't give equity, but cash will be provided to whoever exercises the options, which is phantom stocks or stock appreciation rights. So even though cash is paid, why it is categorized in this equity valuation scenario is because the cash would be dependent on what is the value of equity. The derivative of this instrument would be equity. Though equity shares are not issued, whatever is the value of equity, to that extent cash will be paid, and that's why it should be. We need to know the valuation of equity while valuing cash settled options. So only one thing I think which may come in between 3 and 4 is optionally convertible instruments. So those instruments will come, say if it is optionally convertible preference share, it has both the characteristics of a dilutive equity instrument as well as a debt instrument. So that is an option, but it comes more between category 2 and 3. We'll see that also in what way that can be valued. So as we discussed, below are the important things we discussed: control and voting rights, rights on profits and assets. So rights on profits we discussed, also assets. Some categories we may have in SHA also, we may have some distribution rights. Say, for example, we can have, apart from voting rights, we can say what all part of the assets of the company can be distributed to one set of instruments, and what else can be distributed to another set of instruments. So these are the rights on distribution of assets. So that also matters a lot for valuation. Then payback horizon how much is the periodic horizon in which we get back. Generally, equity instruments will have a long payback horizon, and debt instruments will have lesser payback horizon. And valuation, protection, and security. If they are secured instruments, then there is no character of equity in that. Mostly debt instruments will have security, and non-debt instruments will not have security. Yeah, so on each of these things, a little bit to see a little more characteristics of the instruments. Equity, as we discussed, no value protection will be there. The risks being no value protection is there. Once it is invested, we don't know whether we'll get it back. No fixed dividend at the same time, and least liquidation preference. So liquidation preference is at the time when the company is under a liquidity event, need not be closing down, or in case of an liquidity event, or essentially more so in case of winding up of the company. Equity would be the last category of shares which gets the money once all other category rights and demands are satisfied. So that's why it is least liquidation preference and longer horizon, which we discussed. So the rewards for this, taking these risks, it would be voting rights and control will be there. Equity are the main category of instrument which should have all the control of the company. However, these days we see other category of instruments like a CCD or CCPS will also have the conversion, also have the control rights. So that is through, say, shareholders agreement or articles of association. Through various other means, CCPS holders can get the rights of voting and control, but primarily only equity shareholders will have voting rights. Then rights on surplus profits. After satisfying all other category of instruments, surplus profits will belong to only equity shareholders, even not preference and other shareholders. Preference shareholders, once you give participation benefits and repayment of capital, they will not have rights on all the profits. That will only be to the equity shareholders. Rights on surplus assets also similar to profits, and high return proposition. Obviously, compared to all other categories, equity should have high return. But nowadays, because of mix and match of different instruments, CCPS also is a high return proposition. So CCPS and dilutive instruments should be looked in akin to equity because they are compulsorily convertible. Then pure debt instruments, completely opposite of equity. No voting rights, no rights in profits, no surplus assets participation, and moderate returns, but they are fixed returns. And these are the risks or negatives, and the rewards for this is secure. It can be secured or unsecured. If it is secured, we'll have a full security of the instrument. But one thing to know is, even though a debt instrument is fully secured, say for example secured on the stock or something like that, then or fixed assets, then maybe it may be little meaningful, because fixed assets cannot be departed from the company unless this debt is served. So, but otherwise, if they are not secured, even though legally companies are bound to pay the interest and repayment of capital, but if the company itself is not having money, then anyway my money will not come. So the unsecured instruments will take a little character of equity as well, because especially in a private company, unsecured instruments, when we see, we need to give little character of equity, because even though it is by law it is compulsorily payable, repayable, if there is no value in the company, if there is no money in the company, then there is no way it can be served. Practically, it would not be secured debt. In fact, so in that sense, debt holders also will get money only if equity holders will get, because if the company is profitable, then debt can be served, in which case equity can also be served because company is profitable. Of course, the order of priority would be debt, but practically the way we can look at it is even unsecured debts also would carry a large amount of risk in a smaller private companies. Even in bigger companies also, as long as it is not secured, it will carry a large risk of repayment and interest being served. Then it will have fixed returns and highest liquidation preference after taking care of the employees and government regulatory dues. Debt is the first category which will get the money from whatever left in the company. Then payment horizon would be fixed. It can be small, it can be long. It would be fixed, but definitely much lesser than equity. So as I was saying, debentures would mostly seen in many smaller companies and bigger companies also. Bonds will be issued by governments, and notes are also possible. There is no legal clarity in India, convertible notes and other notes. So we see more of debentures because when there is no clarity in notes, it's just a terminology. It's not called as notes, but there are some recognition only in FEMA for startups where they can get the convertible notes. Then redeemable preferences, it's a part of capital. So then below what is it mentioned is each category has highest risk and interest, and some categories will have low. For example, redeemable preference shares amongst the debt category has the highest risk, and that's why interest also should be higher, or dividend rate should be higher for redeemable. Then unsecured loan debt would have slightly lesser risk and rewards compared to preference, and secured will have much more comparatively lesser risk and rewards. So next category is dilutive equity instruments. So it's a combination of equity and other instruments. High return proposition, generally this will have highest return proposition because it will have both the category of benefits, and so it will have highest proposition of risk, and that's why it will have highest value also, and more money to be invested also to get it, and more value also will be there. And rights on surplus profits will be there because if it's a CCPS, once it gets converted into share equity, it will have the option, the investment instrument holder will have the option to convert. So once he converts, he has the participation in profits and assets. Value protection is little low because it's as much akin to equity instrument, and liquidation preference also would be the last but one. Just before equity, you may get this liquidation preference. Longer horizon of payback and partial voting rights and control would be there. Should not say partial voting rights because it all depends upon how we structure in articles of association and SHAs. Option to convert into equity would be there, and control on payback timeline could be there. We may have exit clauses in convertible instruments. So commonly seen is convertible preference shares, compulsorily convertible shares, or optionally convertible shares, or convertible bonds or notes or debentures. Last category we discussed was options. I think we already discussed employee stock exchange and warrants. This will have right to receive equity shares in a future on a predetermined price, ESOPs. So once it is converted into shares, it leads to dilution. Cash settled options will have right to receive cash consideration based on future value of equity. So this will not have dilution, this will have a cash outflow. So these are all relating to the different class of instruments and all. Should I take a 1 minute pause and see if there are any questions surrounding this?
I think in the chat box, few doubts were raised.
Okay, I will just see that. Okay, risk is geography risk. Okay, I think that's there in the last session. What are the notes and debt instruments and one under the dilutive equity instruments? Okay, I think I explained it later. Note is say a convertible note or anything which is not much prevalent in India. In US and other markets, it's called as notes, but you can consider it as debentures for India context. Both CCPS and OCPS will fall under dilutive instruments. Similarly, CCDs, OCDs will fall under the same. Yeah, both will fall under. Actually, it will fall under dilutive instrument also, and it will fall under debt instrument also because it has option. Both can be possible depending upon whatever the instrument holder chooses. It will lead to. We have one example of that in the later, and that we can discuss that. Okay, D-long here shared. Okay, that's about it. So I'll share.
Convertible notes. Sir, convertible notes that are there in debt instruments. I mean, in debt instruments category, the notes which are appearing are those convertible notes?
One second, I'll go back to the slide. One second.
We had these notes as bonds also, bonds/notes in the debt column.
Okay, I'll go back to it. This you're saying? Bonds/notes. Yeah,
Yes.
so bonds and notes are debt only. If they are convertible, then you see in here, if they are convertible, it is dilutive equity. If they are not convertible, it is only pure debt. Does that answer?
Yeah, actually, if you could give some example for notes which are there in debt instruments.
Yeah, so as I was saying, instead of notes, you can view it as debentures because in India, notes are not common. It's just a name being different. No, none of the Indian laws except for FEMA provisions for one category of instrument for startups. It uses the term notes. Other than that, there are no, especially from valuation context, there are no difference between note and debenture. We will know, say, convertible debentures, partially convertible debentures, or optionally convertible debentures. So notes could be viewed as similar to that.
Okay. Okay. Yeah.
Okay. So I think there is one more. Okay. So now we'll see some of the examples to understand these all from the valuation perspective. So first example, let's take this scenario. Class A shares, there are 10,000 shares of face value of 10 rupee each and called up 10 rupee, paid up 10 rupee. Class B, 10,000 shares, face value called up and paid up 5 rupee only. So as here, it's important to note the distribution rights pari passu to Class A and Class B. That means both Class A and Class B shareholders have same rights to the distribution. That means if one share of a Class A holder gets 100 rupees from the company in case of liquidation, Class B shareholder also will get 100 rupees irrespective of the fact that his face value is 5 rupees. So that is the meaning of pari passu distribution rights. And let's assume the value as on today is enterprise value, which with whatever method we would have arrived at, it could be market multiple or DCF or any other method, is 2 lakhs. Then dilutive in number of shares is 20,000. It's a simple example, though face value is different because distribution rights are same. The dilutive number of shares would be same, which is 20,000, 10,000 plus 10. And value of Class A and Class B, both shares will be 10 because of the very reason of distribution rights being the same. If the distribution rights were not pari passu to Class A, Class B, the distribution rights were equivalent to their money contribution, then the value of Class B shares should have been 50% of the value of Class A shares. Because it is pari passu, then value is same. So, so this example, though it's a very simple example, very important one, will show us as to how important is each and every clause in the shareholders agreement. One question is there, different distribution rights allowed under Companies Act 2013? Yes, different distribution rights are allowed under the Companies Act. So,
in fact, SEBI rules and regulations highlight the superior voting rights provisions also.
Yeah. As long as things are taken care in articles of association, it's all okay. So second example, Class A is 10 rupees, same as first example. Class B is face value is 10 and called up is 5 and paid up is 5. So here again, distribution rights, same pari passu rights for both A and B. And let's assume the value of the entire company equity value is 3,50,000. So adjusted equity value in this case is should be 3,50,000 because the way we value it here is so enterprise value is 3,50,000 because one category of shares is called up 5 rupees and paid up 5 rupees. There is a potential to receive 5 more rupees from that category of instrument. So easier way would be take 20,000 as a dilutive number of shares and take this 5,000 5 rupees per share as an inflow to the company, which is possible. So today also, if the company needs it today, I can call. So the value would be equivalent to 50,000. Present value would be equivalent to the face value because it can be called today. So the total value of the company for the purpose of categorizing the instruments is 3.5 lakhs plus 50,000, and once we divide it by 20,000, 4 lakh divided by 20,000, each class of shares will get 20 rupees as the value. But class B, when we give the valuation, it should be 20 minus 5 because the value is 20. That 20 I'll get only if I give one more 5 rupees. If I want to buy class B shares, I will see that it is a 20 rupee value, but however, I need to pay 5 rupees whenever it is called on. So it should be 20 minus 5. Of course, we can go into the timing of that 5 rupees if there is a clause in say SHA or anywhere or articles or somewhere saying that in 2023 this 5 rupees will be called. Then all of these numbers relating to the balance 5 rupees should be present value to today. If there is no no conditions like that, it may be considered as is basis.
Obviously, all this information will be as of valuation date.
Yes. So partly called up and paid up shares shall have equal dilution unless distribution rights differ. In this case, distribution rights are same, so the value will be same. I'll keep moving on. Many examples like this are there, but if anybody has any question, please unmute yourself and ask. Or if the questions can wait until end, you can post in the chat box, which can be taken at the end. So here, okay, so yeah, this is
What is assumed equity value?
Assumed equity value is, it's equity value only. Just use the assume because, we have not done the valuation here. Assuming that the equity value is 3.5 lakhs, onward I am discussing after that assumption. Assumed equity value is nothing but equity value under any method, either market multiple or any of the methods.
It is enterprise value after,
after value you can take, yeah. After reduction of debt portion value from the enterprise value. So examples for next category, these were pure equity valuation examples. Now equity itself, pure equity, but with differential voting rights, how do we value? So here class A 10,000 shares, 10 rupee face value called up and paid up. Class B 10,000 shares, 5 rupee called up, paid up, same example. Only one change is class A shares has 10 votes per share and class B shares has 1 vote per share. So distribution rights is pari passu. Again, the very important factor is distribution rights here also, because it is pari passu. Even though class B has been paid only 5 rupees and even though it has only 1 vote per share, it still will have the same share, same value as that of class A. As we can see, class A has 10 rupees, class B has also 10 rupees. But another adjustment to be done is discount for lack of control, because I only have 10% voting rights compared to a class A shareholder. If class A shareholder has 10,000 shares, he has 10,000 votes. And if I have 10,000 shares, I have only 1,000 votes. So to that extent, we need to adjust the instrument by providing additional discount for lack of control.
But how can that be pari passu?
For the distribution of value. So whatever assets are there in the company, if we have pari passu, I give pari passu rights for both a class A and class B. Both the category shareholders will have equal participation in the asset list in the company. Though voting rights are less, they have equal participation. Okay, so now all of these categories we saw examples earlier, we saw equal distribution. So in case distribution rights are different, then how do we see? We saw both the categories in all examples having equal pari passu rights. If they are different, how do we value it? So in this example, similar example, class A, class B shares, voting rights are same as last example, class A 10 votes, class B 1 votes. However, distribution rights, class A has 1 weight per share, class B has 2 weights per share. So it's an interesting example where voting rights are less for class A, but distribution rights are more for class B. It may be very uncommon, but definitely possible. And as an example, definitely it is worth considering because it says lots. Why I'm saying very remotely possible is where there is more participation in surplus assets, there will be more rights generally. But in this example, we are taking lesser rights and more participation for class B, and more rights and less participation for class A. But still, it will be certainly possible if there is an influential brand or company, then they may invest money. They may not be bothered about controlling the company where confident about the promoter group and all, but still because of their money, they would have get more rights. And the slightly different version of this is true in case of a CCPS or CCD, where you can have a higher participation rights, and your voting rights may be restricted in some cases. Okay, so here until each category value, it is same, like the dilutive instruments are same 20,000 only. Sorry, so dilutive instruments will change here. As you see, if you just take the face value of the share, number of shares on the face of it, it will be 15,000, 10,000 class A, 10,000, 5,000 class B. But because class B has 2 participating rights, we will consider that as one class B share would be taken as 2 shares for the purpose of computing dilutive number of shares. Please do not take this dilutive shares just as the name name itself. So in this case, if you see the books of accounts, MCA records, dilutive shares would be 15,000 only. But for the purpose of valuation, to get the right value for each instrument, we will consider that as 20,000 because they have the economic benefits of 2 shares. One share of class B has the economic benefit of 2 shares. And that is why by making it 20,000 dilutive shares, when we compute per share value and multiply it with each class per category value, we'll distribute 2 lakhs into per category. Class A will get 1 lakh and class B will get 1 lakh. When we compute per share value, it will become class A will become 10,000, 10 rupee, and class B will become 20 rupees. Again, once we arrive at this, because class B has lesser voting rights, an additional discount for lack of control should be given to class B order. So this is about differential distribution rights. It's a simple example we have taken. I think it is clear. So now we are moving on to, as the below banner says, conversion of dilutive equity shares. So here we are moving into, until now we saw pure equity shares with differential voting rights and differential distribution rights. Now we are seeing convertible instruments. We have not touched too much about debt instruments because it's a simple way of valuing, but at the end of the session, if there are any questions or in 5 minutes, we can discuss that. So in the first example, in dilutive instrument, equity 10 rupee paid up and not conversion ratio not applicable because their equity itself. Then there is 0% preference shares. I'm little doubtful if 0% can be possible, but for simplicity of example, we have taken 0%. Many cases, people take 0.0001%, which is almost same as 0%. Practically also we see in many companies. So 0% preference shares, 5,000 number of shares, paid up 5, and the conversion ratio 1:1. 0% debentures, same conversion ratio 1:2. Every single debenture will get 2 equity shares upon conversion. So preference shares and debentures are compulsorily convertible, and assumed value of the equity is 2.5 lakhs. So here dilutive instruments would be 25,000, which is 10,000 equity, 5,000 preference, and 5,000 into 2 conversion ratio, which is 10,000, totally 25,000. Equity share per value is 2.5 lakhs divided by 25,000 is 10. Preference share value is 10. Debenture value is 20 because that has 1:2 conversion ratio. Simple example, I think it is clear. Next example. I think everything is same as the above example. Even preference and equity shares will have compulsorily convertible equity clause only, but value is 1 lakh. In the above, value was 2.5 lakhs. Here the value is 1 lakh. So dilutive number of shares is same. When we compute now valuation, 1 lakh divided by 25,000 shares will give equity value as ₹4. And the preference share value would also be same because that is 1:1 conversion. Debenture value is becoming 8. So it is just to give a simplistic scenario. We have given this, but to understand on a conceptual level. But when we see similar example in practice, it may differ because we need to really do a proportionate valuation distribution. Though conceptually it's the same concept, but we need to do a proportionate valuation distribution and then arrive at the value so that sum of all instruments also will be equal to the equity value. So here, so what we need to understand here is value of debenture would be twice the value of equity and value of preference here.
Hello.
Yes.
Yeah,
Yes,
Mr.
correct.
Harshad.
Huh. Sir, here we have seen the 0% preferential which is compulsorily convertible in the equity shares, right?
Yeah. Yeah.
See, but if the convertibility is at the later date, not at the valuation date, then is it necessary to adjust this while calculating the fair value of the equity shares?
Yes, when once it is compulsorily convertible by statute, there is no way to view it. I mean, retain it as preference share. Only for the to the extent of dividend, annual dividend, it is preference shares. But except for this dividend, because it is compulsorily, the very nature of compulsion, there is no other way than to look at it as other than equity share.
So,
No,
So
actually,
for the
Mr.
dividend.
Harshad's point was, if I have understood it rightly,
uh,
what if the conversion price is not decided upfront? This 1 and 2, we are not aware of it now.
Sure,
Companies
sure.
Act
That
gives
also we
us
have
the,
example. We have
okay.
example of that kind in the later things. Is that okay,
so
Harshit?
Yeah,
okay.
just one question.
Uh,
The
Sure.
for the compulsorily convertible share, can the price which is decided be lower than the current market price?
Price which is decided or price which we have valued?
No, price which is decided for conversion. Say, let's say it's converted, it is convertible
Yeah,
3 years later. Can
yeah,
it be
yeah.
lower?
So price decided by the parties can be any price, and in various practical scenarios, because of various reasons, it could be different. It could be because conversion ratios are different, or some participation rights are not there, or for various reasons, it can be different.
No,
Uh,
my question is specific. Can it be lower than current market price?
Yes, it can be lower as
Okay.
long as instruments, rights and preferences are different. It can be lower. If the rights and preferences are same as other instruments and market value of other instruments, then there is no reason for it to be different. But at the end of the day, it's an commercial negotiation between the parties. If you have seen any practical scenario where it is different, it may be possible, though technically it is not right.
Sir, Naren sir, when the price is actually lesser than the valued price, then the conversion ratio will change, right? So that will take care of the conversion, right? Conversion ratio will change. If the price is already decided, then the conversion ratio will change.
Yeah,
Is it
Uttam,
not?
if the
No,
conversion
no.
ratio is different, that's why price is different, then yes, obviously, as what you're saying. But I thought the question was all other things are same, but still the value is different. If conversion
So,
ratio and rights and preferences are all same, and still
Uttam,
value technically cannot be different.
yeah, Uttam, the example is, let's say current market price of the company, you can take either Reliance or Alok Industry or whatever. Let's say it's 100. Can you issue compulsorily convertible preference shares at say 97?
Sir, if your question is relating to whether legally it is possible as per
Yeah,
laws,
legally,
or
only legally. I'm
okay, okay.
just saying.
Legally, okay. It depends upon various other things. Whether are we issuing it to a resident or a non-resident company?
Yeah,
It
correct.
depends
Okay,
upon
I'm,
various
I'm
things.
only resident. Only resident.
Yeah,
In
resident, it should
certain
be
conditions,
possible.
is it's possible, right?
Yeah, yeah, it should be possible. I don't see any issue, but still we need to see from income tax perspective whether what is the 5627B valuation and all of that. But technically possible, but some scenarios maybe there it is not possible. For example, market value is 100, but 5627B value comes to 90. And if you are issuing at 97, then 7 rupees could be subject to tax. So, but on a high level, it is possible. But there could be some situations where it is not. It may lead to tax also, though it is possible.
Chinmay, and when it comes to these convertible instruments, which compulsorily convertible instruments,
Yeah,
when we do the valuation on a fully diluted basis,
yeah.
so we are treating the convertible instruments and equity at the same value. Is it not that for such convertible instruments, debt instruments, we'll have to treat it as a debt until the period of conversion, and
Or
on
if it
the
is compulsorily convertible, it should not be treated as debt. It should be treated as equity. If it is optionally convertible, we need to. We have different examples later for optionality.
awesome, awesome. Okay,
Yeah,
thanks.
sure.
Hello,
Okay.
hello, hello.
Yeah, yeah. Please.
Sir, see, if we see the convertible debentures, okay, or compulsory convertible preferential, anything. If we say debentures, So I'll pay, say, on 30th June is my valuation date, say, and
Yeah.
the period of, say, the convertibility period or that debenture period will be, say, up to the 30th June 2021, right?
Okay.
I am doing as on valuation date of 30th June 2020.
Yeah.
That is on today. Okay.
Yeah.
Now I am paying the interest to that the debenture holder, right? That
Yeah.
is tax implication. I will get the 1 minus T. Okay. I'll
Yeah.
get the tax benefit. Okay.
Yeah.
So as on today, I have to take the interest into account. Okay.
Yes. Yes.
And is it necessary to add the debentures and convertibility as on today only? Means I have taken to
Yes. Yes.
computation the
Understood your
convertible
question.
equity
Yeah.
sharing
Yeah.
today
Understood your question.
in the
Irrespective of
valuation. Yes.
yeah, irrespective of whenever it is getting converted in future, as long as it is compulsorily convertible, we need to view it as on par with equity. And also because it will earn interest at the end of it, after you compute the debenture value, we need to add the present value of interest.
We have to add the present value of interest.
Interest, yeah.
Okay.
Because apart from what we are computing is equity value,
Right.
but this debenture class has more benefit than equity. Apart from being 1:1 compulsorily convertible, it additionally has interest benefit also.
Exactly.
So that interest would have gone as in our future projections at the time of computing enterprise value. That interest also would have gone as interest break.
Yes.
But depending upon whether it is FCFE or FCFE, whichever way, but it would have gone if it is required. Irrespective of whatever is the treatment we would have done, at the instrument level, once we compute the value of compulsorily convertible debentures, which is equal to equity, on that value you will add the present value of interest to that.
Okay.
Clear,
Okay.
right?
And when we are doing the cash flows, we ignore the interest which is paid on these convertible instruments. We will have to ignore the interest.
I think you should give the direction
Exactly.
because because we can't view it as an external debt because it's a compulsorily convertible instrument.
Yeah, but
So
now this is add on the valuation date. The nature is of interest on debenture. So
no,
it is
always it is interest only.
Ah.
Interest nature is always interest only,
Correct.
but the instrument is not a debt instrument.
Okay. Yes.
Yeah.
Okay.
So it's a slightly confusing, but it's because it's a combination of two instruments.
Because for the purpose of taxation, we are taking as a interest, not as a dividend. But if you see from the accounting point of view or fair value point of view, it is equity, not a debt.
Correct.
So
So from
Chinmay,
fair value point of view and valuation perspective, I mean for accounting fair value point of view and also for valuation from any perspective fair value, it is equity only.
Yes.
Only for our income tax provisions it is debt.
Exactly.
And
Exactly.
just one tip here, please do not try to compare income tax provisions with valuation. Those are two different things.
Right. Exactly.
And
No, but the amount
not
will
only for
change.
this
No.
study also income tax. Yeah, income tax is a specific law. Whatever is
Correct.
read out, whatever is told in the section will apply, whether it is logical, illogical, fair or unfair.
Exactly.
For example, 11 US says fair market value of the instrument, and then they'll define NAV. So
Right.
we should just go with the literal reading. There is no logic in that.
So just to summarize our discussion now, the
I would like to raise one question. In case of a profit-making company, which is a dividend.
Sure. I think you went to mute, sir.
Dividend also. So in that case, making the valuation, whether
Sir, your voice was breaking. You may need to repeat. For some time, we could not hear you at all.
Okay. I would repeat. In case of a dividend-paying company, its comparison of the value with the compulsory convertible debentures, the debentures are subject to interest, whereas the dividend is payable on the equity. So when we are doing the valuation, whether the adjustment for the dividend needs to be done in case of equity, whereas in case of convertible debentures, we are making adjustment for the interest. So in case of equity, whether the adjustment for the dividend is to be done.
No, sir. Dividend adjustment need not be done because the dividend will be paid only as a part of the future value of the company. So entire value of the company, we are treating it as for the equity holders only, including in this case debentures, because they are being treated as equity shares. So entire value is treated as their value only. So no question of additionally taking dividend value. But in case of debenture interest is not belonging to equity shareholders. This is only as a specific additional payment to debenture holders. So we need to deduct this debenture interest from enterprise value by way of in future cash flows we need to deduct, and then specifically add only to the debenture holders.
So in the same example, how about CCPS with say 2% or 3% dividend coupon rate?
Same treatment.
No, I think Chinmay, I think something. This looks like double counting. When I'm doing a future projection of cash flows, let's start at the interest component. Any instrument which I consider it as debt, which is then I can take that interest. But any instrument which I consider as equity, and I'm calculating the equity value, I cannot take both interest and also the value.
Hello.
Yeah. So correct. But in this case, only for CCDs should not be considered as debt, even in the computation of enterprise value also, because if we classify this as an external debt, then it will be very difficult to value it as equity. I mean, we will be contradicting ourselves. So the simpler way would be classify debenture as equity all throughout. That is why if it was an external debt and we would not have deducted interest in future cash flows, so consider it as equity and consider this interest as a separate additional payout. Don't do any adjustments for any of the debt category. Just take it as a separate line item of expense of interest and add that in the debenture holder value.
Why should I consider a payout? That's my question. If I'm not considering any dividend for equity, I'm at the FCFF level wherein I'm calculating and I'm going to subtract value of debt. In that case, I have not considered any interest.
Yeah, logically, what you're saying is right, sir. But still, why it is advisable to consider is, in case of dividend is available for all category of shareholders. So you don't need to consider it as an expense there in the future cash flows and then add again, because it is available to all categories.
But in case of debentures, fully convertible debentures, it will be available only when it is converted. Till such time the dividend is not available to the debenture holders.
Yes, sir, but it is compulsorily available. So if you feel that it is available, say after 5 years or after 20 years, in projections also we need to take after 20 years. And anyway, interest, when we are adding to debenture holders, we are adding present value of interest. So that when you calculate present value, already the timing will take care.
Hello.
Chinmay,
Hello.
I think that there's one complication which they are bringing out, which is that suppose your debenture is converting after 1 year.
Sure.
Suppose it's a dividend paying company, that if you're considering interest, what they're saying is don't consider dividend. Consider one, either interest or dividend. So maybe there's an adjustment
consider
possible.
One. Okay, I'll rephrase. See, dividend on equity or equity shares dividend will not be considered as expense. Will not be considered as a payout at all in any of the circumstances, because dividends are available to all the category of shareholders, and we are valuing the equity instrument itself. When we are valuing the company per se, primarily we are valuing equity. So a dividend which comes to equity is already categorized in our present value computation. Whatever future present value comes.
Agreed. Chinmay, that's agreed. You are perfectly correct in all that. The only adjustment which they are saying which could possibly be made is that for 1 year, this debenture holder will not get dividend. That's the only adjustment they are saying.
Okay, that cannot be done, Abraham, because if we don't show this, say, interest expense for 1 year, then my value for equity is overstated, because actually that much cash flow will not be available to equity shareholders. There is a dividend payout. Say if 100 is the cash flow for next 1 year, net cash flow, and there is a 10 rupee dividend payout. If we ignore the 10 rupee and take entire 100 rupees as available to all category of shareholders, my equity value is overstated.
But that won't be considered in the market value of debt.
No, we will not see debentures as a market value at all, because debenture we are categorizing as equity.
No,
So
one second. Sorry, Chinmay. Just so that we understand. Assuming I have convertible debentures, compulsory convertible debentures, and in other scenario I have a normal debenture.
Sure.
What I do for getting the value of the company equity is nothing but a free cash flow to the firm and subtract the market value of debt. That's what I do.
Right.
Yeah.
Now, when I'm doing a free cash flow to the firm, I'm agnostic as regards to the interest outlay that I have for the future cash flows, and then I subtract the market value of that. So, in the case of a compulsory convertible debentures, you are asking us rightfully saying that it should be considered as equity. To that extent, my debt is zero. To that extent, assuming nothing else is there.
Yes.
So therefore, my
I think it's correct.
FCFF is FCFE. Now, then when I divide by number of shares, I'm considering whatever debentures are there has been converted into equity, and therefore I get a per value share as your statement here.
Yes.
Where is it that interest we have to adjust in all these line items? That's my question.
Okay, so in your example, if there are both compulsorily convertible debentures and redeemable debentures are to be converted as external debt and take the market value of that external debt. As you mentioned, that is correct. No need to do the interest adjustments or anything is not required. It is as good as a loan which is existing in the company. No other special adjustment required. But for compulsorily convertible debentures, it cannot be looked as an external debt, and one would not get the market value of this CCD also. It is highly impossible to get the market value of CCD because the market value of this CCD is equivalent to equity value.
Correct.
And there is no way. That's why we can adjust it as a external debt instrument.
Okay, so we'll adjust the interest component, but while deducting the debt value, we will not deduct it for the purpose of convertible.
Yes,
okay.
exactly.
And sir, can we do
from
for
enterprise value? It will not be reduced as a debt.
Right, exactly.
And interest will be given only, and only dilutive number of shares will be increased even to the extent of debentures.
Exactly, that's what I want to ask. See, in EPS, we always show basic EPS as well as dilutive EPS, like. Okay, here also can we do that way because hello.
Yeah. Yes.
Because nominator will be same. Okay, only denominator will be changed. Okay,
correct.
So can we show it as this is a basic FMV, basic fair market value, and the dilutive fair market value accordingly after.
Yeah.
Can we show it like that way in report?
It can be shown. But definitely, it has to be shown in this way only because even though all practical scenario technically from valuation point of view, we look at all it as equity instrument itself. Just the nature of instrument and in your articles and the certificate, the way it reads as a preference share, debenture, and all.
Correct.
So that's why the disclosure separately would be better.
Okay.
And there is one more step. After calculating the per share equity value on a dilutive basis, we apply the conversion ratio, arrive at the equity value of the debenture, and to that we add the discounted value of discounted interest earnings of the instrument up to the period of conversion, right, Chinmay?
Yes.
So Chinmay, sorry to be on this topic for some more time. Just one thing, that is, suppose we get the enterprise value first minus the interest, and then after that we can divide the equity value among all the shareholders, right?
Yes,
that would be a better way to do it, right? And then after that, suppose let's say it's a dividend paying company, and in this case, the company is some of the instruments are not entitled. You're able to hear?
Yeah, Mr. Abraham, we can hear you.
To the next,
so if some of the instruments are not entitled to share in the dividend, then maybe an adjustment for dividend could be made.
No, if any instrument is there which would not be eligible for dividend, very likely that they are not equity instruments or convertible instruments. But if there are some instruments which, say for example, is convertible, but as we discussed in earlier cases, the distribution rights may be restricted, and let's say only for every one share, only 0.5 distribution ratio is there. So in which case, like we did in the earlier case, we need to change the dilutive number of shares itself rather than making any other adjustments. Because when it is not eligible to dividend and distribution rights, to that extent, it's not equity.
Okay, thanks. I think you carry on, Chinmay, and then we'll keep some of these questions for later.
Sure. Okay, so the next example is on the convertible instruments only. a slightly varied scenario. So here equity is 10,000 shares, paid up is 10, and preference is 5,000 shares, 5 paid up, 1:1 conversion. Here the debentures has an interest component. I think lastly we discussed this already in the previous slide, but I'll quickly run through. So 10% interest is there for this 1:1 conversion. All preference and debentures are compulsorily convertible, and debentures are converted at the end of the term. Enterprise value is 2,50,000. Present value of interest of debentures is assumed to be 50,000. So here, since everything is 1:1 conversion ratio, the dilutive number of shares would be 20,000. Equity value is 2,50,000 minus the 50,000, because that's why to make it little clear here, I've used enterprise value as 2.5 lakhs. Once interest, present value of interest goes away from it, it will become 2 lakhs. So equity value is 10 per share. For preference also same 10. For debenture, it will be 10 rupees plus another 10 rupees, which is 50,000 divided by 5,000, which is 10. 50,000 present value of debenture interest divided by 5,000 number of debentures, which is another 10. So 10 plus 10, it will be 20. So it is in line with what we discussed all this while. So I'm just moving on to the next example.
Just one point, since you have considered interest here, that means in the actual cash outflow, okay, that interest will not be covered there, right? Of course.
Just to I mean, the way to be done is preferable to show it in the actual cash flow as well as interest outflow, but to make it clear in the presentation, I've brought that to here. Another slightly variant example on the same topic. Equity same, preference also is same, and debenture, there is no interest in this case. However, I think it is relating to one of the question also earlier raised. If you see the conversion ratio would be based on future value per share as on conversion date. So we are seeing many of the capital instruments being valued in this way. It's a slightly complicated in terms of concept, and also a lot of basic understanding is compromised in this kind of structures, because so we need to that way look little differently. I think these are the examples because of which I went little detailed in each of the nature of instruments in the beginning. And so in this example, what we are saying is that the debentures are there. Like preference shares, you see 1:1 conversion ratio. The debentures conversion ratio is indeterminable today. It is not said that the debentures are converted based on, say, 1:1 if turnover is so and so, or 1:2 if turnover is Y, something like that. That is to an extent there is an indication how do we determine, but there will be some cases where it will be absolutely indeterminable, because as it is told here, it will be based on the future value of the share as on the conversion date. Conversion date we will not know, because debentures has at say 20-year time period as per company's law. The instrument says at any point in time in that 20 years, either the company or the shareholders may opt to convert. So we don't know when it is getting converted, and at what price it will get converted, that also we don't know, because that is based on the value as it is there as on that conversion rate in the future. So we have tried to make this as in a slightly simpler way to solve it and get the answer, and at the same time not compromising any of the technically any of the requirements of valuation norms. So I'll just go step by step in the left side now. Then I'll come to these final numbers in the right side. So assume gross value of the equity is 3.5 lakhs. Debenture liability 50,000. So here what I am saying is I am looking at, though it is compulsorily convertible debentures and akin to equity, for a moment I am assuming this as debenture. Not that I am assuming this as debenture for my entire valuation. For a moment I am assuming.
You're not audible, Chinmay.
For a moment, I thought I was not audible.
Yeah, I was also scared last time. That was why. I think Chinmay has a bit of a problem. But it's a very good example.
Mr. Chinmay, we lost you for a minute, so you can repeat.
Okay. So I was saying that gross equity value is 3.5 lakhs. And for the moment, only for this calculation, I'm taking the debenture as debt and not equity convertible. That's why I'm reducing that as an external debt 50,000. And another assumption here is whatever is the value of issue, value of debt at the time of issue is assumed to be market value, and we are reducing it as 50,000, and net value is 3 lakhs. And because net value is 3 lakhs, to determine per share value, we are considering only 15,000, which is 10,000 equity, 5,000 preference shares. So there is parity, 3 lakh net value, which is excluding debentures, and number of dilutive shares 15,000, which is excluding debentures. So per share of dilutive instrument is 20. So so 20 is per share. Now if you go back and take this 20 and compute the number of equity shares to be issued against the debentures, which is 3.5 lakhs divided by 20. If we do, then we will get 2,500. So if you see the right side, 3.5 lakhs is the total value.
No, I think it is 50,000 divided by 20.
50,000 divided by 20, sorry. 50,000 divided by 20 will give 2,500. So then 2,500 means total dilutive instruments is 15,000 plus 2,500 would be 17,500. So we are getting 20 only. This is a cross check. So just at this level, because I told you that we are assuming it as debenture and all of this, you may get a question, okay, how do we report in the report? Because we are saying this is an assumption and all of this. This is also, though it is an assumption and everything, this is also an accepted practice, internationally accepted practice, where we should call it as trial and error, where I have arrived at conversion into convertible number of debentures as 2,500. And it is logical also, because if we see one basic assumption here is the value of debentures, say for example, after 5 years, say, let's assume the conversion date will come after 5 years, and the conversion value, some X value will be there after 5 years. The present value of it, whichever X value will come and whatever period it comes, the present value of that value should be equal to 15,000 if my allotment at 50,000 is at arm's length. If I have taken 50,000 rupees and given 5,000 debentures, which has these convertibility clause, if this is at arm's length price, if this is not influenced or no other economic benefits or no other factors are there, it is just arm's length. I've taken 5,000 rupees and 50,000 rupees and 5,000 debentures are issued. Just that is all is the fact. Then it is also true that whatever is my value on a future date, that present value of it is 50,000 only. It could be 5 lakhs, it could be 50 lakhs, it could be 1 crore, whatever it could be value on a future date. Present value must be equal to 50,000 as long as my current transaction is at arm's length. If I have a feeling that my current transaction is not at arm's length, maybe because this is issued to a group and some other influencing factor are there, or for any reason this is not as arm's length, then only my assumption will go wrong. Otherwise, my assumption that whatever is the future value is equal to 50,000 today is right. So once we assume this as right, then my dilutive instrument of 2,500 rupees is also right.
Where did you adjust the debenture interest here?
Debenture interest, so for simplicity, we've taken it as 0% debenture rate. Debenture interest has to be adjusted.
Where will you adjust it here? In the 3,50,000 minus debenture interest, and then you divide it by 17,500. Is that how it is?
Yeah. When we arrive at gross equity value, we would have given interest deduction to future cash flows. In future cash flows, you give interest deduction. And also when you compute debt liability here, 50,000, here interest gain should be considered.
So Chinmay, suppose there is a clause in the agreement which says that it will get converted at a 20% discount to the then at the conversion rate at the point of time of conversion. So then we just adjust the ratio and convert, right? That may be sufficient.
No, actually, even if it is 20% conversion to the future value and all, still we should apply the same thing because as I was explaining, if we assume that this is at arm's length, then whatever value in future I get, whether after 20% discount or in whichever way I get some value. Let's say in future I get 1 lakh as the value. 50,000 I've taken money and given 5,000 instrument. And after 5 years, if I get 1 lakh as the value, my assumption is that 1 lakh's present value is equivalent to 50,000. Because this transaction is at arm's length, it has to be equal to 50,000. So even with the discount or whichever way we work out, it has to be 50,000 only.
Abram sir, in that case, on the left side of the screen, there is this number of dilutive shares 15,000, value of dilutive shares is 20 rupees, and by dividing the current market value of debentures 50,000 by this 20 rupees, we have arrived at 2,500. So instead of doing this, what we, correct me if I'm wrong, Chinmay,
Yes,
instead of dividing by 20 rupees, we'll have to divide it by 16 rupees, which is 20 rupees into minus 20% discount.
Yes, even I had a similar view of Mr. Uttam.
No. That 20% discount is not for all category of shares. The 20% discount is only for debentures. The debentures will get, you will get converted at 20% discount, not for all category shares. So we can't reduce.
In which case, if we have not applied the 20% discount as per the agreement, then the number of debentures, the number of equity shares to which the debentures will be converted will be 2,500. But if we apply the discount, then it will be actually the number of equity shares will be more than 2,500. It will be 3,000 or depending upon the discount amount.
I think what Chinmay is saying is increase the debenture liability by the amount of discount and then calculate. Is that what you're saying, Chinmay?
No. Debenture liability will not be increased. Only if there is an interest, debenture liability has to be increased. See, it also, depends upon, how exactly the clause is worded and other things. But if it is just the 20% discount is there on the future, and possibly, I think what Uttam was referring to is right. We need to deduct that 20% from the dilutive value and then take it as, and then accordingly compute.
Chinmay, I need to get back to you again on this.
Sure.
You have the gross equity value of 350,000. The debenture liability that you subtracted is the market value of debt or the book value of debt?
Market value, no?
Perfect. Market value of debt.
Yes.
So once you get the value per dilutive equity share, would you calculate the equity shares to be issued by taking book value of debt divided by this price or the market value of debt divided by this price?
Sorry, I lost you, sir. What was the question?
Assuming in this example 3,50,000 minus the debenture liability, let's assume the market value of debentures liability is say 1 lakh.
Okay.
So now you are left with 2.5 lakh and calculating value per dilutive share comes to 15 rupees. Let's take that as a reference point. Now, would I consider equity shares to be issued against debentures on the book value 50,000 divided by 15 or on the market value 1 lakh divided by 15?
Sir, while calculating WCC, we take market cost of debt. Here also we take that concept of market value of debt.
I think we may have lost Chinmay for his voice. We're not here.
Because the interest portion is inbuilt in the calculation of market value of debt. The present value of interest component is inbuilt in the market value of debt.
We will wait till Mr. Chinmay connectivity is restored.
Sir, I think it should not be the market value of the debt, but the book value of the debt. The reason why it should be the book value of the debt is that would be the liability of the company to repay the debenture holders. So the second item here, 3,50,000, we will have to deduct the book value of the debentures.
No. That's market value always. Whenever you're considering the equity value, the firm value minus market value. The question is about the actual.
Sorry, I just little lost in between.
Yeah, we lost you in between, Chinmay. So I think you can carry on from. See the question which they had. I think they can repeat the question, then you can take it.
Yeah, I take this opportunity. Chinmay, taking this example of 3,50,000, the debenture liability that we are subtracting the market value of debt. For example's sake, I said it is 1 lakh. Book value is 50,000, but the market value of debt is 1 lakh. So to that extent, when I calculate the net equity value, it is 2.5 lakh. And then because you have 15,000 dilutive shares, value per dilutive share is 2.5 lakh divided by 15,000.
Yes.
That comes to approximately 16 rupees. Let's take that as a reference number. Now the equity shares to be issued against debentures, is it book value of debt divided by this value per dilutive share, or is it market value of debt divided by dilutive per equity share? That is 1 lakh divided by 16 or 50,000 divided by 16.
Okay, the debenture which is supposed to be issued would be, computed on the future date, not on today, assuming that all facts remain same even in the future date also. So at that time, value, so whatever number we got here below, in your computation, if it has come to 2,250 or 2,750, some number you may mention, so same number of instrument will be issued against the debentures.
Yeah, so you are saying that the principle, the question is the market value of debt value, whatever you get, that divided by the value per dilutive share should be used to calculate how many shares it will be issuing. Is that correct?
Yeah, correct.
Thank you, that helps.
Sure. Was there any other question? 1 or 2 minutes I was not, I was lost in the session.
Same thing, Chinmay.
Okay, sure.
Chinmay, one just doubt that I had. Okay. In this, when you're reducing debenture liability at 50,000, right?
Okay.
Are you not going against the terms of the debenture which says that whenever the conversion happens, it will happen at fair value? Right? So the amount that should be reduced into debenture liability, you're not assumed conversion terms which are consistent with the terms present in the debenture itself.
Yeah. So it's the same. Are you saying that instead of 50,000, should we take fair value of debentures?
That is what if the debenture holder has been given an instrument which says that conversion will happen at fair value, should that not be the value considered inside
Yes, exactly. It has to be fair value, but the issue would be how do we determine the fair value? See, this debenture fair value is not equivalent to any other debenture which is there in the market because it's a compulsorily convertible debenture.
Right.
So the debenture value would be equivalent to equity and not any other market debenture which is available, any company for that matter. How much ever closely comparable company, it would not be equivalent. It would be equivalent to equity. So determining fair value is not possible. So the assumption is that the debentures are issued at fair value. So whatever is the issue price should be fair value as on date.
No, but that would have been the fair value as on the date of the issue, right?
Yeah, correct.
That is not the fair value as on today's date.
So correct? So if understood.
So if at all you have to make an assumption that the debenture is comparable to the equity, okay, then for the purposes of valuation, take the enterprise value. From that, deduct the value of the preference share. What remains is the value of equity holders. Okay, divide that by 15,000. Per share value, you'll get it as if the debenture has been converted into equity, and that is the value corresponding to 5,000 of them should be the value that should be reduced as a debenture liability, right? Not 50,000.
Yes, that is true. However, in which case determining preference share value, so to value any of the instrument, equity or preference, we need to have this black box of debenture value. So on a trial and error method, it is possible, or an option pricing model, it is possible to do, but in a simplistic way, it is not possible. I'm just explaining the simplistic way for now. But what you're saying is absolutely true, sir. But in this manner, simplistic way, it will not be possible to compute.
But in the problem that I see with this calculation is, I don't see you honoring your commitment to your debenture holders.
Yes, sir. So on the date of issue, the debenture holder commitment should be equivalent to the money received from them, right? On a later date, it is different. I agree. I'm seeing this situation only on the date of issue.
Correct. No. On any date other than date of issue, this issue will be there.
Yeah, other than date of issue, this is not the best method to follow. The best method to follow should be either an option pricing model or trial and error basis, value both, and on a waterfall mechanism you need to determine.
Yeah, right.
So, however, just practically thinking, anybody who is not able to adopt those methods for lack of information or anything, if it is for a regulatory reason, for FMA or an income tax, I'm making the assumption that the instrument value is equivalent to the issue price, even on a later day. Maybe it is it is next best than following an option pricing model, if for lack of information, if it is not being able to do.
No, but my question is, supposing let's say you have to do this 2 years from after the date of issue,
Yes.
right?
Yes.
Then, as you said, if this debenture is not comparable to any other instrument in the market, we have to make an assumption that debenture is same as equity.
Yeah.
Okay, then might as well value this debenture liability at assuming that this debenture is actually an equity share itself.
Yeah. Yeah.
And then whatever the fair value of the equity multiplied by 5,000 is the amount
Yes.
that we have to reduce from here, right?
Yes. Then it will become 1:1 converted debenture. So
Yeah.
it's a simple computation. It will become, if you make that assumption. If you make an assumption that today debenture is equivalent to equity, then all instruments are same category. It will become very simple. But in fact, the debenture is equivalent to value as on a future date, not today's value.
Correct.
Yeah.
This is a little not clear anyway. Maybe think about it.
No,
Yeah,
just
it's a
carry on.
little
I think carry on.
intriguing question. Yeah.
I think that Subraidu will figure it out and we will discuss with you separately offline. Subraidu will go through the details. Carry on,
Yeah,
Sachin.
Sure, we can do that. Okay, so now we are seeing the optionality clauses. So in this case, the first example is equity 10,000 shares, 10,000 paid up, preference 10,000 shares, 5,000 paid up, 1:1 conversion ratio. And preference or debenture, whichever category it could be, we've taken only one category. So these are optionally convertible. Option can be exercised by either company or by the option holder, or maybe some more dependency clauses could be there as to how that option can be converted. And the value of company is 2 lakhs. So here, what we need to do is take the dilutive number of shares as the actual number of shares itself, irrespective of the fact that at what price it will be converted, etc. And then arriving at the value as equal to enterprise value divided by number of shares. But however, here we are assuming that the debentures are fully convertible, and optionality, we are not giving cognizance to this. We'll just see in the next option, or even in this case, the way we need to arrive at the price of option would be based on binomial model or any model. I mean, if it is American option, it should be binomial model. If it is European option, it could be only Black-Scholes. So arriving at the since here enterprise value is equivalent, giving is sufficient that both the category of shares are getting, then it seems like very simple. Both values are becoming same even after applying optionality. But maybe we can just see the next 2 examples and then come back. Then maybe we'll better understand. See, in the next example, almost all the factors are similar, but the enterprise value is 1.5 lakhs, which is even less than the capital contribution of the investors. So the equity value in this case would be 50,000, because the person who is having an option to convert, he will not convert. He will rather opt for redemption, because in 1,50,000, if he redeems, he is getting 1 lakh. If he doesn't redeem, he may get less than 1 lakh. So he will redeem his options, and the balance left out in the company is 50,000. And once a debenture holder redeems, the balance number of shares left out is also only 10,000. So the equity value would be 5 and debenture value would be 10. But in the top, when we saw, since the value itself is more than what he can get by redeeming, or equivalent to that, in whichever way the value would be same. So no need to adopt any other mechanism. The value would be equal to the plain vanilla valuation what we do. And in the second case also, no need to do any further calculation, because redemption itself would be ideal. But however, to be rightly complete the entire loop and to do in the complete manner, adopting the option pricing model, OPM, and then do the workings would be better. But for the conceptual understanding, I'm explaining that even without doing OPM, you can derive the value in this way.
In the scenario number 5, just one sec. Here, whatever we are getting preference value as 10, we will add option value, or that is a totally different method of value?
Here it is considered as options. Here it is considered as the optionee will opt to convert into equity.
Okay.
If he is converting into equity, he is getting 10 rupees. If he is not getting converted, still he will get 10 rupee only. So irrespective of it, value will be same.
So option valuing the option is totally another option which we have as a valuer too.
Yes, that is irrelevant practically, but to make the presentation neater and give the valuation report, if one need to adopt it, they can do it, but they'll still get the same value.
So basically, it's anti-dilutive. That's what you're showing. And yeah. And even then, so if this clause is there, even in the compulsorily convertible, saying that minimum conversion value should be equal to this, then maybe we'll have to adjust it for the minimum value at which it should convert, right? Meaning that similar to optionally convertible, this is basically it's anti.
We'll take that question in the next examples. Here,
Okay,
there is no minimum conversion value. In other words, this is also getting converted at a issue price. So the conversion clause of the debenture is at a issue price. So if the conversion leads to lesser than issue for the debenture holder, then he will not opt for conversion. He will just redeem the shares.
Yeah, that's interesting example. Good.
Okay, so in this example, again, we are bringing on the last section complexity of value being based on the future value. Value of the option is based on the future value. So I think the discussions would be largely similar. Whatever we discussed for the other category, same discussions would come here. So I'm just skipping this, except for optionality. Okay, so here is the liquidation preference. I think 1 or 2 slides earlier also a few people were asking. So this example is to treat how liquidation preferences when it is higher than 1 can be treated and the value is allocated. So first slide has only the facts and second slide will see how we the value. Equity share 10,000 face value and everything. So dilutive stake will come to this column later. Class A is 5,000 shares. Class B is 5,000 face value. And debentures 2,000 numbers, 200 rupees face value. And issue price is 250. Issue price is also very relevant here. Class A is 100, Class B is 200, debenture is 250 is the issue price. Conversion ratio all are 1:1. And then liquidation rights is 1.5x of issue price for Class A. For Class B and debenture, it is 1x. And the amount, liquidation amount, which is the mathematics of 5,000 into 100 into 1.5 in this Class A is 7.5 lakhs. Likewise, 5,000 into 200 into 1x, which is 10 lakhs. And based on the conversion ratio is fixed here, so dilutive stake will come to this one based on the conversion rates. And debenture in this example, first point, I'm reading first bullet. Debenture has the highest liquidation preference. So as per the terms of the agreement amongst the shareholders, debentures has the highest liquidation preference. This is practically also in most cases, whoever is the latest entrant will have the highest liquidation preference. Then after that, debentures, Class A and Class B will have preference equivalent to their liquidation rights. That means equivalent to this 7,550 and 10 lakhs. So the liquidation preference of Class A, Class B shareholders would be equivalent to this 7,50,000 and 10 lakhs. After honoring debenture holders, on the balance, preference shareholders to be honored based on this liquidation preference amount, which is up to for them. Then if the liquidation proceeds after settlement of debentures claim is so debentures claim after setting still liquidation preference are still liquidation proceeds are remaining, then Class A and Class B shareholders will be honored based on this liquidation preference ratio. Then balance proceeds after honoring Class A, Class B shareholders, balance will go to equity. So debentures Class A and Class B preference shares can opt for conversion foregoing preference share. So one important point to understand is in case liquidation Class A and Class B preference shareholders do not opt for conversion, then they will get only 7.5 lakhs. In case of Class A will get 7.5, Class B will get 10. So if they feel that by converting, they have the possibility to earn more than 10 lakhs in case of Class B, then they will lose out liquidation preference, they'll lose out all the rights, and they'll just become equity shareholders. So if they don't feel that they'll get more than 10 lakhs, Class B will not get converted. He will take whatever money comes up to 10 lakh, he will not get converted. That's the fundamental understanding. So now maybe let us see from right side to left side. In case value of the company is 20 lakhs. So in case value of the company is 20 lakhs, as per the order of preference, first we will distribute it to debenture holders, because that's what is the shareholders agreement, as I was explaining. So out of 20 lakhs, entire 5 lakhs goes to the debenture holders. So if we convert, he got his 2.5 lakhs fully, 250 rupees fully. Issue price of 250, liquidation proceeds was equivalent to issue price, so he got it full. And balance remaining is 15 lakhs out of 20. But however, to honor Class A and Class B, we need 17.5 lakhs. Class B is 10 lakhs, Class A is 7.5, 17.5 is required. That much money is not there. So out of the remaining 50, Class A and Class B will get such amount which is equivalent to say 7.5 divided by 11, 17.5. In that ratio, they will get distributed. And since all money is exhausted, equity shareholders are not getting any money in this example. Now moving on to next 30 lakhs, in this debenture holder is getting full, and Class A, Class B are getting full. So it is becoming 22.5. Balance left is 7.5. Whatever is left, equity are getting. Equity shares value is only 75. I think somebody was asking a question.
Please go ahead, Mr. Chinmay.
Oh, sure. So in this case, if you see equity value is 75. What we are saying is, otherwise the valuation needs to be done based on a waterfall model using an OPM or something. But I'm trying to explain that with a simplistic examples where if 30 lakhs is there, how even if an OPM is adopted also same result will get. So in this way, after distributing to other class of category of shareholders, value of equity is coming. So we need to say that value of equity in this scenario is 75 rupees per share. And next scenario, 40 lakhs. I mean, it's just a graduation from the previous scenario. So okay, but one interesting thing here is debenture holders are getting 5 lakhs. Class B is getting 10 lakhs. Class A, because Class A is having 1.5x here and Class B is just having 1x. Actually, and Class A can opt to convert, would also think of converting also, because Class A's share price was 150 rupees. So after everybody's distribution, if you see, equity shareholder value is more than 150. So because equity share value is more than 150, Class A will not will get converted, and he will opt for getting more than 7.5 lakhs. But Class B is not still converting because his entry price is 200 and his assured price is 200. So as long as equity value is more than 200, Class B will not convert. So in this case, only Class A is converted because it is more than 150, which is his threshold. So after that, once he converts and he gets his money, balance left out would go to the equity shareholder, which is in the same valuation as the preference. So all the greens are converted, all the burgundy are not converted. So now when showing 40 to 50, when we go, still debentures holders are not converting, because anyway he is getting, if he converts also he'll get less, because if you see here 225, so he is not converted. Then here when Class B evaluates, he will see 40 lakhs is left out for all three categories. If I don't convert, I'll get 10 lakhs. So might as well convert by getting more than 10 lakhs. So he will convert, and accordingly other shareholders will get. And in this 55 lakh scenario, everybody will can convert. For a debenture holder, it is indifferent whether he converts or he doesn't convert. He is getting 250. But all others will anyway convert, because for Class A, 150 is a threshold, he is getting 250. Class B, 200 is a threshold, he is getting 250. And in case of a scenario, it was 75 lakhs. In any other case scenarios, all the shareholders' value will be same, because everybody are getting more benefit as an equity holder itself and not as a debenture holder. So put it in simple terms, if the value of the company is more than the highest liquidity proceeds holder, then nobody will be converted and everybody's value will be same. But if any one category shareholder if the value of per share in a simplistic computation is less than any one class or category shareholders liquidation preference, then all this complication comes, which is any of these other categories. We need to go class by class and determine. So practically, we may not be able to that simplistically compute. So a detailed waterfall table and band computation it will be required. But this is how largely it works.
This is an alternative. This is an alternative to option pricing model, is it?
This is how exactly option pricing model works. But however, it will have other scenarios like see, in case of option pricing model, what happens is for each of these scenarios, 55 lakhs, 50 lakhs, 40 lakhs, 30 lakhs, each is a scenario. So that will be taken as a different probability, and the probability will be assigned, and finally we get the value. So here we are just seeing each of the probabilities separately, assuming that final value is there. So in case of OPM, when we do, we also see, let's say for example, if a company is getting listed, its value may be, say, here it is 55 lakhs. If it gets listed, it may be 55 lakhs. If it does not get listed and some exit happens, then it may be 40 lakhs. If nothing happens, it gets liquidated, then it may be 20 lakhs. And that's how probability and waterfall will be done. So in a different columns, I've explained for easier understanding. But in practically, when we do OPM to be adopted. Okay. Okay. Maybe I don't think any questions are there. I try to make it as detailed as possible. So I'll go ahead and maybe something is there we can discuss in the end. We are already overshot by half an hour, but I have another 15 more minutes. I can continue. I hope that's okay.
Yeah, sure. Go ahead.
Okay. So last category is equity settled options, last but one category in compared to our initial slide. So in case of options, how do we do? Say ESOPs or something. So equity shares 10,000 in this example. ESOP pool is 5,000, 1x conversion. Out of this 5,000, 2,000 are granted, and out of this 2,000 grant, that means 3,000 are not granted. Out of 2,000, 1,000 is already vested, 1,000 is unvested. Out of 1,000, 500 is already exercised. So now we need to see what is the dilutive. There are different views. Of course, there are no sufficient write-ups either in say ICAI guide, accounting standards, or in Companies Act, or in nowhere there is clarity as to how do we dilute it, and hence we need to check most logical approach. So first logical approach should be that whatever is the ESOP pool is there, all the shareholders have agreed for that ESOP pool. That's why today or tomorrow that will not be belonging to shareholders, and definitely somebody will exercise. Some employee will take that. So let us take entire 500 as dilutive equity shares and then compute the value. So accordingly, there may be a view that so based on the facts of the case, also if the company has already reached sufficient maturity and they don't see that there is a need for ESOP, whatever employees requirements are there, it can be compensated by cash, and ESOP is not required, and board is not planning to issue any ESOP. In which case, even though 5,000 is there, only 2,000 is granted. So dilutive shares equity can be taken as 12,000, 10,000 plus 2,000 instead of taking 15,000. And accordingly, other probabilities may result in this. And anywhere 500 is for sure because it is already allotted. It is actually this ESOP shares should be a part here only as 10,500. But just for showing it in a showing it clearly, I've shown it separately. Yeah. Okay, and then other than this, all other things are same as what we discussed already. But only one point is when we give DLOC and DLOM for ESOP shares, it is acceptable and also prudent to give slightly more DLOC and DLOM than other category of shares. Because ESOP shareholders are very minute, and if you see any ESOP documents, it will be very clear that they don't have any rights at all, and they should be participating in whichever way anybody else is participating. Any exit options are available. Per se, there is no additional. There is no compulsory rights for participating in a secondary. As long as somebody else is dragging, they can go. Otherwise, these guys won't have any rights. So in that sense, and also they will not have any visibility. They will not have any visibility in terms they're not shareholders, so they can't go and attend the shareholders meeting. So nothing would be there. So it is prudent to give more DLOC and DLOM to ESOP category than to all other categories compared to other categories. And Black-Scholes or binomial would be used to value this. And I think nothing additional that. So next is cash settled options. So cash settled options are almost similar to ESOPs. However,
sorry, previous slide.
Yeah.
Just one question is statement when you say ESOP pool authorization amounts to acceptance of dilution by shareholders, irrespective of granting and vesting.
Yeah.
This will be totally dependent upon the terms of the ESOP scheme, correct?
Yes.
Several ESOP schemes contain that until the time exercise actually happens and the shares are allotted and the name of the ESOP allottee gets entered into the register of members as a shareholder, he will not have any rights as a normal shareholder will have, correct?
Yes,
So
sir.
in such an instance, if a liquidation happens, right, then those people who have been granted and vested, okay, and assuming that whosoever been exercised, his name has been entered in the register of shareholders as a member, correct? Only those people would have any right, but granted and vested will not have any rights, right? So it all depends on the terms of the ESOP scheme.
Yeah. So even
here,
though whether they're having the rights or not, it is already diluted. As long as those shares are granted, the share capital table is already diluted. There is no way to get back that shares. It is already diluted. It is just that they will not have the participating rights and they will not have the rights to participate in meeting. All those things will not be there. But from ownership perspective, they will become one day or the other. They will become shareholders unless the company buys it back or something like that happens.
No, but my question was, let us say, as on this date that has been shown in the table right here, okay, as on this date, if the company were to get liquidated, okay, and the proceeds are to be distributed, okay, only those people who have exercised ESOPs and have been granted shares and whose names have been entered into the register of shareholders, only they would be entitled to any residuary distributions, and the granted invested would not get anything.
Yes, sir. Yes, sir. That's why I was saying, I mean, it is subjective to facts. Even in this example, those who are exercised will be granted. When there is a liquidity event, as long as there are vested shares, they can immediately exercise. Even though they have not exercised, as long as... Sorry?
Correct.
So we are looking at a liquidity scenario is more probable. Then we need to take 10,000 plus 1,000. As 11,000 because these will also anyway will get exercised.
Plus 500 also, Plus 500. Okay.
And if we are not seeing any liquidity event in the near future, then 10,000 plus 2,000 can be taken. If we assume that other 3,000 there is no probability to be issued. But if we are looking at liquidity event, it's a very infant stage company, and definitely all the balance shares will be granted one or the other day. It is better to consider 15,000 as dilutive. Okay. So last category, cash settled option. So mostly it is equivalent to whatever we discussed in the ESOP, except for two factors. One is in the computation, we will not increase the dilutive number of shares. In ESOPs also, we discussed dilutive numbers will be increased, but in cash settled options, it will not be increased. And in the future cash flows, whenever the exercise event is probable, on those days, we need to take the cash outflow in the future cash flows, because there is the cash outflow expected and almost for sure in those years whenever they exercise. But it will be very difficult to determine when they may be exercising. So if there are multiple options, maybe we need to make assumptions as to say 10% or 20% will get exercised in say year 2, year 3. Those kind of assumptions we need to make. And then take the net cash flow and then apply the value. Okay, I think this slide is not relating to any other slides, but one of the questions I had received before the session, so I just added one slide on this. But I think to an extent we discussed in the previous slide, maybe I should not touch too much time on this. Yet, how do we compute weighted average capital when debt instruments are involved? A few yes and no's. Should we take book cost of debt? No, we should take market cost of debt. Book equity, debt equity? No, we should take industry debt equity ratio. And then coupon rate of fully secured debentures. If there are debentures, we should not take a comparative of a fully secured coupon, other coupon rate of other debenture or bond if it is available in the market. And if they are fully secured, that's not the ideal comparative coupon rate to be taken. And interest rate charged by related party debt. In case of a related party debt, we should not take that as a comparative. And in case of any debt is there which is from equity holder similar to related party, we should not take as a comparative. And coupon rate for convertible debentures, if any is there in the market, then that also should not be taken. Only interest rate of a third party non-convertible debt with comparable security or no security only should be taken as comparable rate for the computation of. Okay, I think we have a lot overshot the time, so maybe this one thing I'll skip. But anyway, this presentation will circulate. If this slide has any questions, maybe offline we can take, I think.
Yeah, maybe we can have a few questions in the WhatsApp group, which you could consider, Chinmay.
Sure,
if there are
certainly.
Okay.
Yeah. And now also maybe another 2-3 minutes we need to spend. We can spend for questions.
I have one question. May I ask?
Sure, Sheetal.
Yeah, I just wanted to know about share warrants. If the company has issued share warrants, then how do we account that?
So share warrants are similar to say ESOPs or so, because warrants are issued today with a right for buying the shares. Warrant says that say after 1 year you can take say one equity by paying 100 rupees. Buying the share is fixed, price is fixed, and if they are interested at that point of time, they can buy the shares. Otherwise, they can discard the warrant. So similarly, in case of ESOPs also, as long as if the employee is interested to pay the exercise price and take it, they will take. Otherwise, they'll ignore. So we can value warrants in similar to ESOPs.
Just go back to the previous industry debt to equity and book value of debt. Why are you considering industry debt? Why are you not considering company's market value of debt to equity?
So value is market value, debt equity. Debt equity ratio to be industry specific, it is advisable to be industry specific. The fundamental logic is though on a short term the company may have a different debt equity, we don't know after say 1 year, 2 years, 3 years, 5 years what will be the debt equity. So an accepted assumption is whatever an comparable industry is having a debt equity, same debt equity will be there in my company also. That's a assumption.
No, the reason I beg to differ is within the same industry, some could be asset light and some could be asset heavy. So unless you do not have, unless the company is going to move in the direction of industry, otherwise preferably you should consider market value of debt equity of that company. And if you are doubting that credentials for reasons, then you should go to industry debt equity.
Yes, sir, totally agree with you. If there is a clear plan from the company itself that, okay, this is what would be the debt equity in the next long run, then we need to follow the company. But generally, it may be difficult also for the company to give a very long-term horizon. And also, if it's a very matured company, very likely that they'll be somewhere in the range of industry debt equity in the near future. And different debt equity should be temporary issues. But I totally agree with your point. In case there is sufficient clarity for the company itself, then absolutely with that it should go.
In fact,
would that clarity not be reflected in the cash flow projections which would be provided to us?
Yeah.
So in which case, should we not consider the targeted book debt equity ratio of the entity rather than the industry?
Yeah, so if it is considered already in cash flows, and we are sure we have, evidence to accept that, okay, their estimated debt equity, though it is different. Okay, for example, Uttam, if we are taking off, considering, say, if we are valuing, anyway, this is for very matured markets only. Say, if we are valuing Bosch, and Bosch's say packaging division we are valuing. So if Bosch has say 80-20, 80 debt and 20 equity for the packaging division equipment manufacturing, a similar company would very likely to function in the same way, because if it's a asset heavy, they would have obviously taken the debt. If not then external debt, a group debt would have been there. So in some way or the other, matured companies will function in such a way that whichever industries need how much ever debt capital. So from that sense, it's a general, accepted practice that industry debt equity to be taken and not company specific. But if you are not looking at a very matured company, then each company would have its own expectation. We may not even get the right industry also to, in first instance, to choose it. So as other gentleman was saying, we can take the book debt equity.
Market
Thanks,
setting.
Chinmay.
Just one question. When we consider ESOP or share warrants as dilutive, so
Sorry,
we
sir,
need
your
to
voice is very low. Can you be a little louder?
hello.
Yeah.
When we consider ESOPs or share warrants as dilutive, we
Yeah.
need to add the future exercise price to the equity
Yes.
value what we arrive. So
Yes, yes.
the
It'll
present
be
value of that exercise price. So when calculating present value, what should be the discount rate? Should be cost of
so.
equity, WACC? Yeah.
Yes, same discount rate. Best is you can just take that in the future year, whichever year in your cash flows, you can take that in that year cash flows itself as an additional cash flow. Okay, sure. So I think we can wrap it up now. I don't think any further questions are there. So thank you very much, Shilpa, Ravindra.
Mr. Chinmay, one second. We will convey formal vote of thanks.
Oh.
And I request all the members to be on video on while Jivika conveys her vote of thanks. Yes, Jivika.
Thank you, Shilpa. So today I have the privilege of offering vote of thanks to Mr. Chinmay, who is an excellent speaker. So today this was a very insightful session on understanding the cap table. You started with different types of capital instruments, equity, debt, dilutive instruments, and options. You explained them very well. Then you also covered various valuation scenarios with simple examples. Then you went ahead and lucidly explained how to compulsory convertible instruments and ESOP pool while calculating dilutive shares in our valuation. So overall, it was a very wonderful session today, and to our participants who were also very active, and they made the deliberation very interesting. So there were many takeaways in today's session, and I think it has given us a lot of food for thought. And so thank you once again, Chinmay, for taking out your precious time and sharing your valuable insights.
Sure. Thank you so much, Jivika, for a wonderful vote of thanks, and thank you everybody for organizing. And also very big thanks to my colleagues who also helped me in doing this presentation, put up various examples, and a lot of time they spent. Sure. Thank you very much. I also had a lot of fun in taking through all the scenarios and talking about it.
Sir, please share the presentation, sir, please.
Sure. I'll share.